Rewire your mindset for real wealth. Welcome to Profit DNA.
You've heard people talking about stocks. Maybe your coworker won't shut up about Tesla. Your uncle keeps bringing up Bitcoin at Thanksgiving. And you're sitting there thinking, what even is all this stuff? Here's the thing. It's actually way simpler than everyone makes it sound. Let's start with a company, any company. Picture your favorite coffee shop down the street. What makes that place valuable? Sure, they've got the building, the espresso machines, maybe some fancy chairs. That's the physical stuff you can touch. But there's something else, something you can't touch but definitely matters. Their reputation, the fact that people actually like going there, the Instagram photos, the 5-star reviews, that weird seasonal drink everyone loses their mind over. All of that, that's value too, just invisible value. Now imagine that coffee shop needs money. Maybe they want to open another location. Maybe the espresso machine just died and those things cost like 20 grand. The owner's got two main options here. Option 1, get a loan. Pretty straightforward, right? You borrow $10,000, you promise to pay it back with some extra on top. That extra part, we call it interest. The bank doesn't care if your new location becomes the hottest spot in town. They just want their money back plus that interest. In the investing world, we call this a bond. Option 2 gets more interesting. Instead of borrowing money, you could sell pieces of your business, like cutting a pizza into slices and letting other people own those slices. Each slice is a stock, and yeah, that means those people now own a tiny piece of your coffee empire. Here's where it gets wild. Bondholders, they're basically chillin'. They get their steady payments, rain or shine. The coffee shop could become the next Starbucks or close down next month. Doesn't matter. They're getting paid. But stockholders, they're on the roller coaster. If the shop blows up and opens 50 locations, their slice of that pizza just got way more valuable. Of course, it goes both ways. If the coffee shop tanks, if everyone decides they actually hate coffee and switches to energy drinks, those stock slices could become basically worthless. That's the trade-off. Higher risk, but also way higher potential rewards. So let's say our coffee shop gets huge, like massive. They decide to go public, an IPO, initial public offering. Fancy words for we're selling stock to anyone who wants it. This is where the company actually gets money. You buy a share for $50, that $50 goes straight to them. But here's what most people don't get. After that first sale, the company doesn't see another penny. When you buy stock on your phone right now, you're not giving money to Apple or Amazon or whoever. You're buying it from some other random person who already owned it. The company's just watching from the sidelines at this point. So why does the price keep changing? Supply and demand. That's literally it. If everyone thinks this coffee company is about to blow up, they all want to buy. More buyers than sellers means the price goes up. Someone who bought at $50 might sell at $70. And here's the kicker. It's not even about what's happening right now. It's about what people think will happen. The stock market is basically millions of people making bets on the future. Good news? Price goes up. Bad news? Price tanks. Sometimes even rumors are enough. Okay, so you bought some stock. Now what? How do you actually make money? Two ways. First one's simple. Buy low, sell high. You grab shares at 50, wait until they're worth 80, sell them. You pocket that $30 difference. Second way, dividends. Some companies take their profits and share them with stockholders. Just give you money for owning the stock, usually quarterly. Not every company does this, though. Lots of them prefer to keep that cash and grow bigger instead. Now here's where people mess up. They think they can outsmart everyone else. Pick the winners, find the next big thing before anyone else does. And look, some people get lucky, but here's the uncomfortable truth most won't tell you. Even the professionals get it wrong, constantly. These people have entire teams, advanced software, inside connections, and they still can't consistently beat the market. So what chance does someone scrolling Reddit on their lunch break have? There's literally studies on this. A monkey throwing darts at a list of companies does about as well as expensive fund managers. I'm not even exaggerating. That's an actual study they did. And the people who try to time everything, buying and selling constantly, trying to catch every wave, they usually do worse than people who just buy or hold. Plus, they're stressed out of their minds 24/7. So what's the actual smart move? Think bigger, way bigger. Instead of betting on one company, what if you bet on the entire economy growing over time? Because historically, it does. Not every year, not every month, but zoom out and the trend is pretty clear. This is where index funds come in. Instead of buying one stock, you buy a little piece of hundreds or thousands of companies at once. It's like buying the whole grocery store instead of trying to guess which cereal brand will do best. The most famous one? The S&P 500. It's basically the 500 biggest companies in America. Apple, Microsoft, Amazon, all those giants, but also companies you've never heard of that make boring stuff like industrial valves. You own a tiny piece of all of them. The beauty of this approach, you don't need to pick winners. One company goes bankrupt, whatever. You own 499 others. One sector tanks, the others might be doing great. You're basically spreading your risk across the entire economy. And here's the thing about the economy. Over long periods, it tends to grow. Not every day, not every year. There are crashes, recessions, scary moments. But if you zoom out over 20, 30 years, the trend has been up. Plus, index funds are cheap. Those fancy, actively managed funds where someone's supposedly picking the best stocks, they charge way more in fees. And remember, they usually don't even beat the index anyway. So you're paying more to probably do worse. Doesn't make sense, right? The catch is this is a long game. You can't dump money in for 6 months and expect to retire. The market will have bad years, sometimes really bad years. But if you keep adding money regularly and leave it alone for decades, that's when the magic happens. It's called compound growth, and it's honestly kind of insane. Your money makes money, then that money makes money, then that money makes money. It snowballs. Einstein supposedly called it the most powerful force in the universe. Maybe he did, maybe he didn't, but the point stands. The hardest part isn't the strategy, it's the psychology. When the market drops 15% and everyone's freaking out, every instinct tells you to sell and run, get out before it gets worse. But that's usually exactly the wrong move, because markets recover. They always have. Not immediately, sometimes it takes years, but selling during a crash means you lock in those losses forever. The people who make money are the ones who hold through the scary parts. Better yet, the ones who buy more when prices are down. Look, nobody's saying this is exciting. It's not. Index fund investing is boring as hell. There's no thrill of picking the winning stock, no bragging rights at parties, but boring works. Boring builds wealth while you're busy actually living your life. So yeah, that's the stock market. Companies sell pieces of themselves, prices go up and down based on what people think will happen. And instead of trying to beat everyone else at this game, you can just own a slice of everything and let time do the work. It's not sexy, but it's probably your best shot at building real wealth. And honestly, that's way better than trying to be a stock-picking genius and ending up broke. If this helped you out, hit subscribe so you catch the next one.